Dan untuk membahas terkait dengan hal ini, kami sudah terhubung bersama Chairman and Managing Member Great Hill Capital Thomas Hayes langsung dari New York, Amerika Serikat. Hello Thomas, how are you doing?
Hi, nice to speak with you. Thanks for having me.
Yeah. How do you see the U.S. economy at present? Is it actually still doing well compared to the 2008 global financial crisis when the world was entering into recession? As Biden and Yellen said that the U.S. economy is not in a recession, despite of the data shows that U.S. economy is in technically recession.
Well, I agree with you that we're technically in a recession. I disagree with the idea that it's anything close to 2008. It's like night and day. We're just coming off a period of seasonal weakness. In the United States, September tends to be the worst month of the year for the stock market. And we're in a similar situation that we were in June. Going into earnings season, sentiment was very pessimistic. Earnings expectations were very, very low. And analysts were calling for a 20% reduction in earnings revisions, and none of that happened. As a matter of fact, that sparked the summer rally. People weren't positioned for it. And I think we're going into a similar situation here. We have the S&P 500. It's now down 22.5% for the year, but you're seeing earnings expectations only brought down by 3.5%. And I think you have the exact same setup going into earnings, which start tomorrow with the big banks. Analysts are calling for earnings to come down 20%. And I think that the bar for earnings is set very, very low. People are only expecting 2.5% earnings growth for Q3. And I think what they're going to find is earnings growth is a lot higher, and they're not positioned for it. Now, as it relates to 2008, I will say managers are just as pessimistic as they were in 2008. In terms of their positioning. When you look at the Bank of America's surveys, of fund manager surveys, expectations for a recession are the highest since they've been since April of 2020, and before that, March of 2009. Both cases, when pessimism levels got this high, the bottom in the stock market was already in the rearview mirror. In the case of 2020, the stock market lows were in March, and in the case of 2009, the stock market lows were also in March. So I do think that there is a lot of positioning for a bad situation, but I just don't think the economics supports it. I think the consumer balance sheet is healthy. I think corporate balance sheets are healthy. And I do think that the biggest risk we face right now is the Fed overdoing their policy.
And amidst of high inflation followed by the Fed's rate hikes, how big is the probability of U.S. economy hit by recession and stagflation started at the end of this year?
Yeah, so I do think you've seen GDP estimates come down to 0.2% if you look at the Fed dot plot. So it's interesting. Last year, when GDP estimates were 3.8%, for this year, the Federal Reserve thought that it would make sense to have a Fed funds rate at 10 basis points. And now that GDP is collapsing and going to be basically flat for the year, they think that it makes sense to have the Fed funds rate at 4.6%. So it's like a dog chasing its tail. Like Winston Churchill once said, generals are always prepared to fight the last war. And my biggest fear is that they're going to overdo it and have to walk it back. We've already seen instances of that in Europe with the ECB having to go into the market and buy bonds for the periphery like Italy. We've seen it with the Bank of England having to walk back and buy bonds, buy gilts. And we've seen it from the RBA in Australia hiking less than expected. And I do think the Fed will be next. And there are a few reasons that they're going to have to walk this back and maybe not move as aggressively as they intend. First and foremost, inflation is already rolling over. Even the PPI numbers you're seeing, they peaked in March of this year. This morning, we're going to see the CPI numbers. I think we're going to see a similar story. The other thing that we have to keep in mind is Chair Powell has this fantasy that he wants to be Paul Volcker and crush the back of inflation. For every 1% that he increases the Fed's funds rate, it adds $285 billion to the U.S. deficit. So far, we've added $1 trillion a year of interest expense with these Fed fund rate hikes. And while Volcker had the luxury to do that when debt to GDP in 1980 was 30%, Chair Powell does not have that same luxury because our debt to GDP levels are 122%. So right now, that interest expense is approaching the line item of Social Security. So it's becoming very onerous. And I do think that they're going to have to maybe one or two more hikes and then pause. And the market is going to start to sniff that out well before they pause. And we're going to see, I think, a recovery in stocks well before they actually make that pause, many months before, if history is any guide. If they don't do it on a proactive basis, I do think, like in England, like in Europe, the credit markets will force the Fed's hands to ease back when municipalities, when governments, when businesses can't refinance. The credit markets will force the policymakers' hands to ease up on the tightening policy moving forward.
Hayes, as you mentioned earlier about the benchmark of S&P 500, JP Morgan Chase says that the outlook for the benchmark S&P 500 could fall 20% from the current level and could be much more painful than the first. So how do you perceive this outlook?
Yeah, I think that just embodies the level of sentiment in the market. I'm always skeptical of people that come on TV and after the market's already crashed 25%, say the market's going to crash another 20%. These are usually the same people that before the market went down were very bullish. So you have to be very, very, very careful. I think investors have a tendency to get carried away with the pessimistic sentiment, and you are seeing it in managers. I referred to the Bank of America Global Fund Manager Survey. Managers have 6.1% cash. That is higher levels than the great financial crisis lows and the pandemic lows. So the one thing that no one is possibly positioned for is any good news. If we get a geopolitical favorable headwind, that could be a positive. If we get earnings better than expected, that could be positive. If we get the Fed and central banks to ease up, that could be a positive. If the official CPI numbers, which are lagged data from 30 to 60 days back, start to show a deterioration of inflation, that could be good news that no one's positioned for. And what happens when positioning is this extreme, the pain trade is usually in the other direction. So right now, everyone's positioned for more downside. You just look at the data, that's how they're set up. If you get any positive news, no one's positioned for it. So the minute you get that shock type of initial rally, you get a massive amount of short covering. The first buyers have to be the shorts because they lose money the quickest. And then from there, institutions start to put serious money to work off of the sidelines because they run career risk of being underweight into the end of the year during a period of seasonal weakness. So we're pretty optimistic going into the end of the year.
What an interesting review has, but we have to continue our dialogue after this commercial break. Dan jangan kemana-mana karena dialog bersama dengan Thomas Hayes, Chairman dan Manager dari member Great Hill Capital akan kami lanjutkan usai jeda. Tetaplah bersama kami di Closing Bell. Anda menyaksikan Evening Up.
Kami sajikan informasi terlengkap seputar dunia ekonomi.
Minggu ini kita akan melaporkan kepada Bapak Presiden.
Kami rangkum berita pergerakan pasar saham dari dalam dan luar negeri hanya untuk Anda.
Bursa saham Eropa hari ini sumringah di awal perdagangan.
Saksikan Evening Up Senin sampai Jumat jam 5 sore live di CNBC Indonesia. Simak tips terlengkap dalam mengelola keuangan bersama para ahli.
Masyarakat banyak lakukan pembelian secara langsung, seperti contohnya sektor retail.
Dapatkan informasi seputar ragam produk investasi serta analisis resikonya.
Perekonomian domestik sebenarnya relatif masih lebih robust ya, masih lebih terjaga.
Saksikan Invest Time, Senin dan Jumat jam 6 sore, live di CNBC Indonesia. Dapatkan strategi Jitu meraup untung dari para pelaku usaha di berbagai sektor.
Melesat hingga 16,2% dalam sepekan terakhir.
Serta simak berita terkini dan terlengkap seputar sektor real dan analisisnya bersama para pakar.
Salah satu fasilitas yang memang kita persiapkan untuk pelaku usaha di Indonesia.
Saksikan Profit, Senin sampai Jumat jam 10 pagi, live di CNBC Indonesia. Ikuti perbincangan inspiratif bersama Kepala Lembaga, Direktur Jenderal, Menteri, hingga Duta Besar Negara Sahabat.
Indonesia is of course a producer of oil and gas as well as of coal. There are opportunities for Indonesia to export that as well.
Serta simak informasi terupdate seputar kebijakan pemerintah.
Retail business coming to Indonesia, no?
Saksikan Prime Words setiap Rabu jam 2 siang di CNBC Indonesia.
Anda kembali menyaksikan Closing Bell dan kita lanjutkan kembali dialog bersama Chairman and Managing Member Great Hill Capital, Thomas Hayes. Hayes, we will continue our dialogue as we know that global equity markets have been volatile in recent sessions as investors have worried about the impact that aggressive rate hikes by central banks would have on slowing economies. So what should investors do when global economy hit by recession and uncertainty? Should we do the rebalancing portfolio or just take the momentum in stock market?
Yeah, I think certainly you want to look at rebalancing the portfolio, buy more of what's down and sell what's up. I do think that, like Warren Buffett says, you want to be greedy when others are fearful. But in periods like this where there's high volatility, you want to start to buy only the highest quality businesses, the businesses that you know with certainty 1 year, 2 years, 3 years down the road, not whether the stock price will be up, but whether the business will be doing more business 2, 3, 4 years down the road than the business is doing today without question. And sure enough, sooner or later, the stock price will follow that business. The stock price will always catch up with the fundamentals over the long term. And we're looking at franchises that are absolutely no-brainers. You don't even have to think about, for instance, Disney. Disney is a huge business. It's down 55% off of its peaks. There aren't many chances in history that you're going to have, maybe a couple in a generation, where you can buy Disney at a 55% discount in the market. And the stock market, as you know, is the only place when they hold a clearance sale, no one shows up. When things are marked down, when merchandise is marked down, usually in the department stores, everyone goes and buys everything. In the stock markets, it's not the case, and that creates the opportunity. Then you look at businesses like JP Morgan, the best bank in the United States, probably the world, down 41%. They're going to report tomorrow. They kick off earnings season. That's another high-quality franchise that we think is worth taking a look at these levels. And if you buy a little bit today and it goes down in a couple of weeks, you buy a little more. But you take a long-term outlook over the next 1 to 3 years, and I think you're going to be very happy. Then you look at Boeing. Boeing just got an order about a week ago from China Airlines for up to 24 787 MAX Dreamliners. They operate in a duopoly, so they have pricing power with Airbus. The demand for business travel is really coming back aggressively. It's roaring back like people haven't expected. We saw over the summer the leisure travel came back, but certainly the business travel has roared back, and earnings are expected to grow 20% a year over the next 5 years. You can get that business at a 71% discount off of its highs. This is not some small cap or micro cap speculative stock. This is Boeing. There's 2 businesses like this in the entire world, and you could buy it at a 71% discount, and they can't give it away. It's one of these times in history that you get caught up in all of the negativity and all of the sentiment, but the highest quality businesses in the world are on sale.
Yes, the minutes meeting of the Fed shows that they are expected higher rates to stay in place. So how does this hawkish stance will impact on the stock market, especially in emerging markets?
Well, they don't know. Okay, so this is the guidance that they're giving. If you remember last year, when they had expected that there would be no inflation this year and there would be no rate hikes this year. So now that you have inflation, and even though inflation's coming down, they're saying that rate hikes are going to keep going up and that they're going to stay up for a long time. The minute inflation rolls over, they will potentially adjust that policy maybe on a lagged basis. Now, in the short term, the strong dollar has been bad for emerging markets. I do think it's setting up the stage for one of the greatest opportunities over the next 3 to 5 years to get exposure in emerging markets and aggressive exposure. And the one key factor that I look at is the strength of the US dollar. I look at the commitments of traders report, which comes out every week in the United States from the CFTC, Commodity Futures Trading Commission, and it shows me what is the positioning of the commercial hedgers. This is the most important because the commercial hedgers are always early and they're always right. And the commercial hedgers right now are the most short that they have been the US dollar. I know everyone thinks the US dollar is going to go up forever, and you're seeing it on cover of Barron's and some of our major publications. But the commercial hedgers are always right. And they're the shortest since 2020 peak, the 2017 peak, the 2015 peak in the dollar, the 2013 peak, the 2009 peak, and the 2006 peak. So maybe the commercial hedgers will be wrong for the first time in history, and the dollar won't eventually go down in coming months as it has every single time that they've been this short. But our bet is that the dollar is going to start to peak in coming months. And once that happens, that's your signal to start aggressively investing in emerging markets, the highest quality, for the next 3 to 5 years. I think it's going to be a tremendous trade. That includes Indonesia. That includes China for certain. You know, China is the only large economy in the world right now that has been aggressively easing policy all year, fiscal policy, monetary policy. And the impact of that easing and that increased money supply has not yet been felt because they've been in a zero COVID policy since April on and off. It's slowly getting better. And even if they stick with the zero COVID policy, the virus eventually dies out on its own. So I do think after the China National Congress this week, we're probably going to see maybe not an official walk back of zero COVID, but in terms of their actions, starting to ease that up. And you're going to see some real acceleration in the Chinese economy, which is going to help many emerging markets. And then once we see the Fed, the markets start to sniff out that the Fed is almost done with their tightening. The market will bottom a couple of months before they're done, and the dollar will start to weaken. And that is your signal to start to invest aggressively in emerging markets. And we're pretty excited about that opportunity.
Okay, well, what an insightful review. Thank you for joining us virtually, Thomas Hayes, Chairman and Managing Member, Great Hill Capital. Have a great day.
Yeah.